I think we can all agree that the carnage in the markets this year, it's been relentless. Right now, the S&P 500, it's flirting with bear market territory. But I want to take a step back and I want us to look at history to see really what history tells us about the severity of bear markets. And if the index continues to fall, what should we do next? Now, first, a little bit of background on bear markets. So, a lot of times people think that the term bear market came from how maybe a bear attacks its prey, but it actually comes from trading. In this case, trading bear skins in early America. You see, the traders, they would often sell the skins before they actually received or paid for them. So a little bit of a bet. And because traders hoped to buy the fur from trappers at a lower price than where they had sold it, bears became synonymous with a declining market. Now, the definition today, it's quite a bit different, right? The definition of a bear market has evolved to mean a drop of 20% or more from recent highs in an index. So the S&P 500, it's approaching a bear market. The NASDAQ and the Russell 2000, well, those two indices are already there. Now, justifiably, investors are anxious right now to know what could happen next. Now, I don't want to be the guy to try and estimate the odds of dipping into a bear market from here. That's a dangerous game. But instead, I want to try to get an idea of what one could look like by using history as a guide. History tends to be a good way to look back, obviously, and kind of look forward as well. First, the impact from a bear market has historically been minimal. There's been about 26 bear markets in the S&P 500 since 1928. However, there's been about 27 bull markets. Now let's take the good with the bad, and the index's total return has still averaged more than 10% annually over that period of time, which, if you're doing the math on that, that means $100 invested in 28 would be worth over $828,000 today. That's with bulls and bears combined. Now, this investment would have also beat inflation for an inflation-adjusted return of 6.8%. But more specifically, bear markets have occurred every 3.6 years on average since 1928. They've also become less frequent since World War II. Let's look at that period between 1928 and 45. There were 12 bear markets. Wow, that's one about every 1.4 years. Now, since 1945, there's been 14 bear markets, or one about every 5.4 years. That's a big difference. Now, something else I want to point out. Recessions aren't guaranteed after a bear market. Now, there have been 15 bear markets since 1950, but only 8 of these predated a recession. Furthermore, half of the S&P index's strongest days in the last 20 years actually occurred during bear markets. And another 34% of the market's best days, well, they took place in the first 2 months of a bull market, which, just so you're aware, that's before it's clear that a bull market has even begun. Now, Shelby Davis, one of the most respected investors of all time, famously said the following for this exact reason. You make most of your money in a bear market. You just don't realize it at the time. Third thing I want to point out, bears, they actually don't stick around for too long. For the S&P 500, through both bull and bear markets, going back to 1942, the average bear market, well, it lasted about 11.3 months with an average rate of return, cumulative return of a loss of 32.1%. But what about a bull market? Well, that average period lasted 4.4 years with an average cumulative total return of 154.9%. Over the last 92 years, bear markets have comprised only about 20.6 of those years. The other 78% of the time, well, guess what? Stocks were climbing. Simply put, we gotta understand that bear markets are a feature of the stock market. They're not a bug, and I think you understand that because we've dealt with them in the past. While they don't happen often, but when they do, they tend to be short-lived and only occasionally signal something like economic calamity or recession. So really, what's the bottom line? What do we have to look at here? Well, in reality, bear markets, they offer attractive returns because investors tend to overreact during sell-offs. But this is kind of like discount shopping. It's just different. When you discount shop at the New York Stock Exchange, it's different than going to a department store. If you're a frugal shopper at the department store, it's easy to go through the sale racks, and you're not going to necessarily go through all that stress involved in buying stocks when they appear to be in a free fall. Now, here's the thing. A cornerstone of our strategy, it's attempting to profit from fear and panic of others. I know that sounds heartless, but again, that's where opportunity sits. So we're already hard at work looking for stocks or indices that are on sale right now. And when we find them, we plan to adjust our allocations accordingly. Historically, bear markets have been some of the best times to invest or increase an allocation to a diversified portfolio of stocks, specifically in certain indices that might be a little bit more beat up. Now, we understand this doesn't always feel the best, but we also know what history has shown us and taught us time and time again, and we want to open that door when opportunity knocks. If you have questions or concerns, please reach out, let us know what those may be, and we're always happy to talk.